Comprehensive income, 80 cents per common share. Net interest income sitting at $93.7 million. Book value hitting 12.90.
Which is up 30 cents from Q1, by the way.
Right, up 30 cents. And they declared a dividend of 51 cents, meaning we are looking at a massive 15.6% annualized yield.
Yeah, the Q2 2026 numbers for Dynex Capital are officially on the board.
They really are. And for you, the retail investors trying to navigate this, frankly, incredibly complex macro environment, this specific earnings release is vital.
Oh, absolutely. Alongside their Q2 presentation deck and the management commentary, this is basically a raw masterclass in capital allocation.
Exactly. So our mission for this deep dive is to completely tear down the machinery behind those headline numbers.
We need to figure out how they actually did it.
Right. We're scrutinizing their aggressive reason-deploy strategy. We are stress testing the leverage that's somehow keeping that double-digit yield afloat.
Because a 15% yield always raises eyebrows, right? We have to determine if the fundamental math actually supports that payout.
We do. We are dissecting the exact mechanics of how they pulled off a 6.4% total economic return in what was a really volatile quarter.
Yeah, an 81 cent per share economic return forces a massive structural question.
Which is, what levers did management actually pull to manufacture that outcome?
And the answer definitely lives in their capital deployment pipeline. I mean, starting with that massive equity raise.
Yeah, let's talk about that, because you really have to look at the sequence of capital movement here.
Right. Management didn't just sit back, collect coupon payments on their existing mortgage-backed securities and just call it a quarter.
No, they didn't. They actively went to the market and they raised $391 million in common equity.
$391 million.
Yeah. And they used their at-the-market, or ATM program to do it, issuing roughly 30 million new shares.
Which is a highly strategic vehicle. I mean, unlike a traditional secondary offering.
Where a company just dumps a massive block of shares on the market all at once.
Exactly, which usually just absolutely tanks the stock price. An ATM program is different. It allows management to sort of drip feed those shares into the open market on a daily basis.
They can essentially pick their spots.
Right. They can sell when the stock is trading at a premium to book value. So they're pulling in highly efficient capital.
And they took that fresh $391 million of cash and they didn't just sit on it.
Oh, no, they immediately deployed it. $2.8 billion into agency mortgage-backed securities.
$2.8 billion. I mean, that single aggressive maneuver grew their total investment portfolio by 11%.
Yeah, inflating it to $27.6 billion overall.
Which is huge. And management, co-CEO Smriti Laxman-Pappano, refers to this as a powerful flywheel.
A flywheel, yeah.
Suggesting that, scaling up the platform enhances efficiency and broadens their access to capital.
That's the company line, sure.
But I look at this through a totally different mechanical lens. It feels less like a flywheel and more like a turbocharger on a massive diesel engine.
Okay, I like that analogy.
Because you are forcing more air and fuel, in this case, equity and debt, into the combustion chamber to generate vastly more horsepower.
Right.
But, turbochargers put immense stress on the engine block.
They do. And the stress on the system is actually the perfect place to focus right now.
Why is that?
Because running a $27.6 billion portfolio requires a massive operational apparatus. But if you look at the financial results, they actually show the engine handling that pressure really efficiently.
Wait, really? How so?
Their fixed operating expenses actually dropped by $5 million quarter over quarter.
Oh, wow. So they grew the asset pool by 11%, but their fixed costs went down.
Exactly. When you spread a slightly lower fixed cost base over a much larger asset pool, your underlying efficiency metrics just improve dramatically.
Right. But let me challenge the fundamental value of that turbocharger for a second.
Go for it.
If I'm holding Dynex stock and management just issued 30 million new shares, my slice of the pie just got visibly thinner.
Sure, the dilution fear.
Right. As a retail investor, my immediate instinct is to sound the alarm on that dilution. Is this rapid expansion actually creating durable value per share?
Or are they just empire building?
Exactly. Are they just trying to grow the overall asset base so they can tout a larger footprint on Wall Street?
It's a completely fair question, but the ultimate litmus test for that exact concern is book value per share.
Okay.
If a REIT issues 30 million shares and the book value per share drops, then yeah, the existing shareholders were just diluted to fund that growth.
The capital raise would be destructive.
Completely destructive.
Yeah.
But look at the actual Q2 print. Book value per common share climbed. It went from $12.60 at the end of March to $12.90 at the end of June.
Okay, so they essentially issued new stock at a premium, which created an immediate 30-cent accretion to the fundamental value of every single share outstanding.
Exactly. The math just flat out proves the deployment was accretive. They captured a premium on the equity raise, applied their target leverage, bought high-yielding assets, and the net result was positive.
Net positive energy for the shareholders.
Yeah, they expanded the pie and simultaneously made every individual slice of that pie richer.
But getting richer requires buying the right assets, right?
Oh, absolutely.
Because they deployed $2.8 billion in a single quarter, which kind of forces us to audit exactly what is sitting on this $27.6 billion balance sheet.
And when you look at the breakdown, it's essentially a monoculture.
Yeah, it really is. 99.99% of the investment portfolio is parked in highly liquid agency securities.
Basically the entire thing.
Right. And breaking that down even further, 95%, which is $26.1 billion, is in agency residential MBS.
Leaving just about 5% in agency commercial MBS.
Which to a lot of people might look crazy, putting all your eggs in one residential basket.
It looks crazy until you understand the structure. That hyperconcentration is completely by design.
Because of the word agency, right?
Exactly. It is crucial to understand what agency means in this context. These securities carry a guarantee from government-sponsored entities.
Like Fannie Mae, Freddie Mac, or Ginnie Mae.
Right. So if you're holding these, the credit risk is totally different.
It's basically the financial equivalent of farming in a heavily subsidized greenhouse rather than, out in the wild.
I love that.
Because if a homeowner stops paying their mortgage, the bondholder Dynex, in this case, doesn't take the loss. The government agency steps in, covers the shortfall, and makes the bondholder whole.
Right, meaning the credit risk, like the risk of actual consumer default, is completely engineered out of the portfolio.
Wow.
This is not a bet on the strength of the U.S. consumer or housing market resilience. It is purely a macroeconomic bet on market liquidity.
In the shape of the yield curve.
Exactly. It's a bet on the spread between borrowing costs and asset yields. Yeah. If you look at non-agency credit assets, sure, you might find a higher yield.
But you are absorbing all the default risk.
Exactly. By stripping out that credit risk, Dynex isolates their exposure purely to rate and liquidity management.
Well, let's run the math on those yields then, because this is where the mechanics get incredibly tense, honestly.
Yeah, the margins are razor thin.
For the quarter, interest income was $302.7 million. You subtract interest expense of $208.9 million, and you are left with that net interest income of $93.7 million.
Right.
But the effective yield on their massive residential MBS portfolio is sitting at just 4.98%.
The spread is incredibly tight.
Which exposes the entire structural reality of this business. You cannot pay a 15.6% dividend to your shareholders when the underlying assets are only yielding 4.98%.
No, you can't. The math simply does not work unless you are applying massive structural leverage to multiply that baseline yield.
And leverage is the absolute core of the agency mortgage REIT model.
It is the engine. They use the repurchase agreement market, the repo market, to fund this entire operation.
Looking at the financing tables, they have over $22.6 billion in repo borrowings outstanding right now.
Which is a staggering number.
It is. I always think of the repo market as a highly sophisticated pawn shop for institutional billionaires.
That's a perfect way to visualize it.
Because Dynex takes billions of dollars in government-backed mortgage bonds, hands them over to major banks, and walks out with cold, hard cash.
Yep.
And they pay an interest rate on that cash. Their average repo rate right now is 3.79%.
Right.
And they use that borrowed cash to buy even more mortgage bonds. Then they pawn those new bonds to get more cash.
It's just a continuous cycle.
Yeah. Short-term
borrowing to fund long-term assets. And the critical metric here is the net interest margin.
Let's break that down.
So they are earning 4.98% on the assets, right? And they're paying 3.79% to fund them in the repo market.
That leaves a very thin net spread of about 1.19%.
Exactly, just over 1%. So to turn a 1.119% spread into a double-digit return on equity you have to multiply it.
Which they do by levering up the balance sheet.
Heavily.
But what's interesting is despite adding $2.8 billion in new assets this quarter, their leverage ratio actually decreased.
Yeah.
It dropped to 8.1 times equity, down from 8.6 times back in Q1.
Which might seem counterintuitive, but that is the direct mechanical result of the accretive equity raise we talked about earlier.
Oh, because the equity base grew.
Exactly. When you issue $391 million in new equity, your denominator, your capital base, expands significantly.
Right. So even though they added new debt to buy the newly acquired MBS, the equity base grew fast enough to pull the overall leverage ratio down.
And running 8.1 times leverage on a purely government-guaranteed portfolio, that's actually considered very manageable within this specific sector.
Manageable, sure, provided you have the liquidity to survive the margin calls.
Always the catch.
Because in that billionaire's pawn shop, if the value of your pawned mortgage bonds drops because interest rates shift, the banks don't just wait around. They demand more collateral immediately.
Which highlights exactly why Dynex is maintaining what can only be described as a fortress balance sheet when it comes to liquidity.
They reported $1.6 billion in cash and unpledged securities.
Yeah, and to contextualize that $1.6 billion represents 51% of their total equity.
Wow, over half?
Right. When you have $22.6 billion in short-term repo borrowings constantly rolling over every few days or weeks, a $1.6 billion liquidity cushion is your absolute lifeline.
It's what lets you absorb shocks in the funding markets without being forced into a fire sale of your core assets.
Exactly. A fire sale is a death spiral for an M-REIT.
Well, absorbing shocks brings us directly to their hedging strategy. Let's audit the book value roll forward, because this is where the financial engineering really shows its teeth.
Oh, this is the best part of the report.
The company reported a net gain of $102 million on the investment portfolio, net of hedges.
Right.
But here's the catch. The underlying assets themselves actually lost value in Q2.
They did.
The fair value of their MBS and loans dropped by roughly $26.5 million, and their TBA, or to be announced securities, dropped by $19.2 million.
Which, honestly, that asset depreciation is completely expected in this kind of environment.
Right, because of rate movements.
Exactly. And just to clarify, to be announced securities allow them to gain forward exposure to the MBS market without taking immediate physical delivery. It gives them a ton of flexibility.
But whether it's physical or forward, when interest rates fluctuate, bond prices get hit.
Always. But their top-down macroeconomic hedging strategy completely inverted those losses.
Completely wiped them out.
It's honestly a flawless execution of macro protection. While the physical bonds lost value, their interest rate swaps absolutely exploded.
These are derivatives engineered specifically to gain value when borrowing costs rise, right?
Right. And they exploded by $135.2 million in fair value. Plus, they pulled in over $16 million on U.S. Treasury futures.
So an interest rate swap is essentially an insurance policy on your borrowing costs.
Pretty much.
You agree to pay a fixed rate to a counterparty, and they agree to pay you a floating rate.
Right.
So if market rates spike, the floating rate you receive goes up, flooding your balance sheet with cash that perfectly offsets the fact that your underlying bonds just lost value.
Exactly. It's a brilliant hedge. And when you net the $45 million in asset losses against that massive $150+ million in hedge gains, you walk away with that positive $102 million net change in fair value.
The swap book acted as a massive flood wall.
It performed exactly as designed. And beyond just the directional hedging, management is aggressively policing their counterparty exposure.
Right. Keeping equity at risk with any single financial institution strictly below 10%. So I see the $102 million net gain. The flood wall held this quarter.
It did.
But let's look at the stress tests they publish in their sensitivity tables. Because, no hedge provides perfect immunity.
No, there's always leakage.
According to their own internal modeling, an instantaneous 100 basis point parallel shift upward in the yield curve, meaning rates broadly spike by a full 1% overnight, would drop common equity by 9.4%.
And a 100 basis point downward shock drops equity by 6.9%.
So the duration gap always leaves some exposure.
Yeah, you can't hedge it all perfectly.
But think about that. Even at a reduced leverage of 8.1 times, a sudden rate shock still evaporates nearly a tenth of the company's equity. If I am a retail investor drawn in by a 16% yield, seeing 10% of my book value exposed to a single macroeconomic rate swing feels like an enormous underlying structural volatility.
It's intimidating, I get it.
Isn't that downside risk the real cost of admission here?
It is the cost of admission, yes.
Yeah.
But a 9.4% equity drop on a 100 basis point instantaneous shock is, counterintuitively, a demonstration of highly disciplined risk management.
Wait, walk me through the mechanics of why losing 9% of your equity is a win.
It comes down to the multiplier effect of leverage.
Yeah.
Unhedged, if you're running 8 times leverage on a $27 billion portfolio of long-duration fixed income assets,
Yeah.
a 100 basis point move could wipe out 50, 60, maybe even 70% of your book value.
Oh, wow. Okay.
Right. So containing that theoretical blast radius to just 9.4% requires incredibly complex, precise swap positioning.
That puts it in perspective.
Furthermore, the real world rarely delivers a clean parallel shift across the entire yield curve anyway.
The curve usually twists. Short-term rates move differently than long-term rates.
Exactly. Look at the nuanced scenarios they model in the deck. Take a bear flattener, where short-term borrowing costs, like the 2-year Treasury rise, by 100 basis points, but long-term rates, like the 10-year, only rise by 50.
What happens then?
Under that specific curve twist, their model shows equity dropping only 5.1%.
Okay.
Alternatively, in a bull steepener, where short rates drop aggressively by 100 basis points and long rates only drop by 50, their equity actually gains 0.2%.
So the hedging matrix is not built to freeze book value perfectly in place.
No, that is mathematically impossible while maintaining any sort of yield. It is built to ensure survival, protect the core dividend-generating capacity, and navigate those complex curve distortions.
And the survival of the dividend is what ultimately matters to the shareholder here.
Absolutely.
But beyond the hedges, there is another mechanical force at play that management highlighted in this report: spread tightening. They noted that the fair value of their agency MBS benefited late in the second quarter, specifically because the spread tightened.
Spread tightening is basically the silent engine of book value growth for an M rate.
Let's explain that. The spread is simply the gap in yield between a risk-free U.S. Treasury bond and a mortgage-backed security, right?
Right, because investors demand a premium, a higher yield, to hold a mortgage bond instead of a Treasury.
Because of prepayment risk. If homeowners refinance, the bond gets paid off early, and you have to reinvest that cash at lower rates. So you demand extra yield to take on that risk.
Exactly. But when market sentiment shifts and demand for liquid, government-backed assets surges, investors are willing to accept a smaller premium.
So that gap, the spread, narrows.
And when the spread shrinks, the actual market value of the mortgage bonds currently sitting on Dynex's balance sheet goes up.
Independently of what the Federal Reserve is doing with base interest rates.
Yes, they are constantly monitoring and trading around these option-adjusted spreads on a daily basis. It's a huge part of how they generate returns.
Let's synthesize the mechanics of this quarter then. Dynex Capital basically executed a highly technical, aggressive scale-up.
Textbook execution.
They tapped the open market to raise $391 million in accretive equity without crushing the stock price.
Right.
They deployed that capital to swell their agency RMBS portfolio to over $26 billion, locking in government-guaranteed cash flows.
And they leveraged that portfolio at a really tightly controlled 8.1 times, utilizing over $22 billion in repo funding while keeping $1.6 billion in cash as a protective moat against margin calls.
Plus, they calibrated their interest rate swaps so precisely that they turned a depreciating asset base into a $102 million net gain.
Yeah, all of which culminated in growing the fundamental book value by 30 cents to $12.90, while spinning off a 15.6% annualized yield to you, the investor.
It is a surgically clean quarter.
It really is. But the paramount takeaway for anyone actually holding the stock is understanding the origin of that yield.
Right. It doesn't come for free.
No, a 15.6% payout is your compensation for holding the immense complexity of interest rate risk, repo funding vulnerabilities, and yield curve shifts.
Dynex proved in Q2 that their top-down, macro-driven management team has the architecture to handle it. But you have to actively monitor those sensitivity tables.
You really do.
Which leads to a macro thought experiment to leave you with, synthesizing a dynamic we actually pulled straight from their liquidity slides.
Oh, this is a great point to end on.
Right now, money market funds are warehousing a staggering $8 trillion in asset balances.
8 trillion. It's an ocean of capital.
Currently just sitting on the sidelines earning a safe, risk-free yield. But if central banks aggressively pivot and a cycle of rate cuts eventually starves those money markets of yield.
But that massive wall of capital will be forced out.
Exactly. It'll go hunting for safe returns. And if even a fraction of that $8 trillion bid hits the market for high-yielding liquid assets like agency MBS.
How violently could it compress those spreads and drive up the asset values Dynex is currently warehousing?
Exactly. It is a structural shift that could radically reprice this entire sector.
It really is the ultimate catalyst for the next macro cycle, something everyone needs to be watching.
Absolutely. Well, that is the structural breakdown of Q2 for Dynex. To make sure you don't miss our daily, completely unsugar-coated teardowns of the most critical earnings reports driving the markets, make sure you follow the show right now. We will see you on the next Deep Dive.